Have you ever wondered why it's important to diversify your investments? Does the phrase, "don't put all your eggs in one basket," ring a bell? This is actually one of the fundamental principles of investing, known as investment diversification. Now, what exactly is investment diversification? Imagine you are planning a meal. You wouldn't just serve bread, would you? You'd want to include a variety of foods to make the meal balanced and enjoyable. Similarly, investment diversification is about spreading your money across different types of investments, or assets, to balance the risk and return. So, what are the benefits of investment diversification? For starters, it significantly reduces the risk of loss. If one asset performs poorly, your other assets can cushion the blow, much like having different food items in your meal. Secondly, diversification can potentially amplify your returns. By investing in a broad spectrum of assets, you have the chance to benefit from the growth in different sectors. Lastly, diversification provides a safety net against market volatility. When the market fluctuates, not all asset types will react the same way. Thus, having a diversified portfolio can help stabilize your investments. In essence, diversification is a risk management strategy that can lead to higher returns. These investments could include stocks, bonds, real estate, and other asset classes. The idea is that if one investment performs poorly, others might perform well, which can offset potential losses. This is akin to not having to rely on just bread for your meal, but having other food items to fall back on. But why is this important? Consider the stock market. It can be volatile, with prices fluctuating rapidly. If all your money is invested in stocks and the market dips, you could lose a significant portion of your investment. However, if you also have money in bonds or real estate, these investments could provide stability during stock market downturns. Let's now take a moment to look at some examples of how diversification works in practice. For instance, you can diversify your portfolio by investing in different sectors of the economy. This could mean having shares in technology, healthcare, and manufacturing industries, among others. Additionally, geographical diversification is another effective strategy, where you spread your investments across different countries or regions. This helps to mitigate risks associated with economic downturns in a specific region. Lastly, as we've mentioned before, diversification can be achieved by investing in different types of assets like stocks, bonds, real estate, and even commodities. These examples illustrate how diversification can help to spread risk and increase potential returns, preparing you for any uncertainties that may come along the way. Now let's delve a little deeper. Diversification doesn't just mean investing in different asset classes. It also involves diversifying within an asset class. For instance, instead of investing in the stocks of a single company, you could invest in several different companies across various sectors. In a nutshell, the key points discussed today are: remember, diversification can't guarantee profits or protect completely against loss in a declining market. However, it can significantly reduce the risk of major losses and improve potential returns over the long term. So, the next time you think about your investment strategy, consider diversification. It could make the difference between a feast and just having bread for dinner. Until next time, keep your investments diverse and your portfolio robust.